In this week's video, we'll discuss the importance of discerning between bear market and correction probabilities. In our approach to the markets, we can't emphasize enough the importance of maximum flexibility. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. Based on the observable evidence, we did take an incremental move away from risk on Friday depending upon when you came in as a client. If you own home builders, we did lock down some profits in that position. One of the reasons why was this breakout level here was taken out during Friday's session. So where do we go from here? We always want to have guideposts. Guideposts help us with try to remain patient levels, and we may need to take some additional action levels. The S&P 500 closed Friday at 2071 and change. The levels of note, the 2064 acted as resistance where my cursor is, resistance where my cursor is, somewhat of a consolidation here near 2064. We can also look at Fibonacci retracement levels from the February low here at 1980 up to the recent high. Those levels are 38.2% is 2066, a 50% retracement is 2049, and a 61.8% retracement of this move from this low to this high would be 2033. Also interesting to note, if I draw a trend line from this low here to this low here, that also comes into place somewhere in the neighborhood of 2033. So from a probability perspective, it appears as if this range is important. Some other relevant points regarding this trend line here. Notice the slope of it. It's a bullish slope. It's sloping upward. Not made a significant lower low yet, even on a daily chart. We would have to close below 1980. Also notice the slope of this line. So this low and this low came before this high. If I take this parallel line and move it to this high here, it did bound price, telling us that the probability of this line still being important is higher than it would be otherwise if this slope didn't match here. It doesn't mean we have to come down here, but it means if we do, the market may respect this line here. It may not. We always keep an open mind, and that's why this is called possible support. If you're relatively new to the markets, it's easy to toss and turn at night wondering if these levels will hold. Under our system, we really don't need to expend too much energy there. Why? If they don't hold, we have rules and we have evidence that we can use as a guidepost, and if we're disciplined, we know that we will take action. That alone reduces stress. I don't need to know if these levels are going to hold in advance as long as I have an if-then game plan in place. If 2064 holds, no problem. If we come all the way down to this level here, that's not a problem either if I'm prepared in advance and I know what I'm going to do. If the market does this, we will do this. If these levels are violated and we move into this area here, the odds are extremely high that we will be making more chess moves. We'll head into next week with an open mind. We did hold at 2064 on Friday, March 6th. This is the daily chart of the NYSE Composite Stock Index that we've been watching, and it illustrates the point about maximum flexibility and heading into the markets each day with as little bias as humanly possible. This is a bullish breakout here, but you'll recall a couple of weeks ago we said there's a reason why we have the term failed breakout. Nothing guarantees that a breakout's going to hold. We failed at this level. However, if you consider the breakout really to be above these blue lines here, you could make an argument that this is a bullish breakout here and that we're retesting that general area. We also have the 50, the 125, and the 200 converging here, telling us that not only are these trend lines potentially important, but this area here in general is important. So as always, we'll keep an open mind. We could bounce in this direction. There's a lot of white space here if we don't hold, and therefore we may have to take additional incremental steps away. We can't make any assumptions as to where the market may or may not hold. If it holds here, that's fine. If it gets into this level here, we can't assume that we're not at the early stages of a 3-week or 3-month correction. The previous chart gives us a nice segue into the main topic of this video, which is trying to discern between the risk of a correction relative to the risk of a new bear market. This is the S&P 500 daily in 2008. These are multiple moving averages the market model uses as a reference point. A peak in the stock market here. Some takeaways. Notice prior to the October 2007 bull market peak, we had already seen vulnerability in the market. Look at the slopes of these moving averages here. Then we came up. This is our trend line here. We broke a trend line right here. And then we made a lower high, that's step 2, and a lower low. This is a trend change here. Now when price tries to rally back above the moving averages, it has trouble here. That's not a good sign. Look at the slope of the moving averages. We come back up and we fail again with bearish slopes. These are all yellow flags for either a significant correction or potentially the early stages of a bear market. How does this chart compare to the present day using the exact same moving averages? There are definitely some concerns on the present day chart, but it does look better, and in the end it's going to tell us that we're really probably looking more at the probability of a correction occurring from this type of profile rather than a bear market. Why is that relevant? A correction tells us that after the weakness, the market would go on to make a higher high. That's somewhat the definition of a correction, which means we can give our positions a little more rope. Notice the slope of the moving averages. It's different for the most part than what we saw at the peak in 2007. They're bullish here. Also, we don't have anything in terms of a trend change yet. We do have step 1. We broke this trend line. So 2 other things would have to happen. We'd have to come up and make a lower high relative to this high and then a lower low. Some of the things to be concerned about. The tightness of these moving averages says that the trends from different time frames are converging, which tells us if we break to the other side, as we did here in October, we could get a relatively rapid move to the downside. So we'll keep an open mind, but this chart looks better in several ways relative to the peak in October of 2007. Using the same techniques to assess risk in the present day relative to risk in October of 1987. This is a much more difficult situation. You can see our moving averages have a positive slope, and this trend is actually a little bit stronger with this white space in here than what we have in the present day. There's a however coming, though. Before the plunge here, we make 2 discernible lower highs. And when we break here, this is starting to look a little bit more like what happened in October. Notice it takes some time to get from this look where we're above to this period here, but no question 1987 is more difficult than many examples in history. If we zoom in on the slopes in the present day, there's only one that's rolling over. All of them are up except for the fastest one, which is the blue moving average. Contrast that with the 1987 setup. In the present day, price is above all the moving averages. Here in September, this is a full month, maybe 6 to 8 weeks ahead of the plunge, price starts to drop below. We can also see moving average rolling over here. And then when price is coming through, we have a much more susceptible slope look to our moving averages. Similarities to today. Today has this tight look telling us if we move through the moving averages, we could get something similar to what we saw in October of last year. So there is risk in this market. We can simplify the concepts using standard moving averages is the 50-day in blue and the 200. This is October of 2007. Here's the peak. Notice the slope of the 50. Price is congregating around, above, and below. The slope turns over and we get a bearish cross here. You can see when all of this happens, we're at 1480. Eventually, the market goes to 666. In the present day, we have some similarities with price congregating around the 50, but for the most part, we've stayed away from the 200. We've got a decent amount of white space between the 50 and the 200, and the slopes of the moving averages today are better than they were at the peak in October of 2007. One concern would be this flattish look of the 50. If we get a break below a flat 50, as we did before the October decline, it does tell us to pay attention here. So we have that flat look. We'll have to see what price does near the 50 next week. The market model uses numerous moving averages on multiple time frames as reference points. Now we're moving to a weekly time frame. We've taken price off so we can focus on the moving averages. This is the October peak. This is 2008 here. Notice we've got negative slopes, negative slopes. This is high risk here, and then price does plunge. These are the exact same moving averages, and there's no question that the trends in the present day are much, much healthier than they were in October of 2007 and early 2008. The last chart and this chart tells us again that the probability of the next bout of weakness being a correction is much, much higher than it being the onset of a new bear market, which would tell us if we come down, even if a bear market will start in 3 to 5 months, we would most likely come back up and either make a new high or come very close to making a new high. Anything can happen in the markets, so we'll always keep an open mind, but the probabilities help us decide how quickly do we need to move away and how much rope can we give our positions. We can give positions more rope in this profile than we could with this profile. The present day market is not without concerns. We've already noted that a tight moving average profile like this tells us that we have higher risk if we move to the other side. Price tends to agree. Resistance, resistance, resistance. What once was resistance may now act as support in the same general area. This line, the dotted line, also acted as support here and bounced off here. It's not as important as this line, but notice they come in this area. The trend line from the October low also comes in the general area, maybe somewhere between 2040 and 2050. Resistance, resistance, bullish breakout also comes into play somewhere around 2040. So if we move into this area here, risks start to increase. There's no question we've been in a frustrating environment, but it's important to let the market come to us, much like letting the game come to us in athletics. On our time frame, which tends to be longer than a trader's time frame, we have an investor's time frame. This is just a very difficult environment. A lot of ups and downs, whipsaws, and no progress or no trend. If we drew a horizontal line from Friday's close, we can go all the way back to 9 months ago. So we're going up, we're going down, we're going up, we're going down around this line, which calls for patience. We have to stick to our discipline. You could say, Chris, this is just the way the stock market is. It's always like this. Well, that's not the case. I've been doing this a long, long time. This is a very difficult 9 months. Let's look at some of examples of periods of multiple months that are a little bit more normal in terms of opportunity. If we're patient and we execute, the market will eventually provide an opportunity either on the bullish side or the bearish side. This period from 1985 reminds us that gains aren't always as difficult to come by as they have been in the last 9 months or so. These charts are almost a way of visualizing future success. When we see things like this, it's much, much easier to stay within our discipline and not get frustrated. Here's a nice positive look from 1998 and 1999. Gold is an example of understanding your time frame and sticking to your discipline. These moving averages, we've showed them in the past in these videos. We never get a bullish moving average crossover here during this rally. Gold recently starts to look good here, and it was on our radar. But we never get the evidence that says it's time to move. Recently, from here to here, gold has struggled. This is a daily chart. This is an 11% drop. We reduced what was already a relatively small exposure to TLT relative to our equity stake. Last week, here you can see we didn't get the higher high that we were looking for. Instead, we have a broken trend line. Step 1. Step 2, a lower high relative to this high. And now, this week, a lower low. Keep an open mind about where we go from here, but this chart has to prove it, and we'll eliminate TLT from our portfolios if it doesn't show us something soon. You may remember last week we said these were bullish looking candlesticks, and after that good things happened and we had a similar monthly candlestick. One note here, we said this was a bullish candlestick. Notice the next month the market was down and very indecisive, and then it moved higher. Bullish looking candlestick, 2 months of indecision before eventually moving higher. Weekly chart of the S&P 500 provides another example of discernible changes on the chart. We did not hold this weekly breakout here. We closed below it. Last week we had a look more like this. Now we've morphed a little bit in the other direction. We don't have the bearish moving average crossover yet, but this is a lower probability look than a look like this. Providing some consistency, this is the longer term look that we show in these videos. If we zoom in a little bit closer on this end and this end, we can illustrate a point. This is the slowest moving average, the dotted moving average. Notice when risk really starts to increase, it's on the top here early in 2008. Right now it's on the bottom and it still looks more like this. These are all updated charts as of the close on Friday, March 6th. These are weekly charts. Nothing significant in changes here, just a little bit more vulnerability, but still in an uptrend, still in an uptrend, still in an uptrend relative to SPY, and these are still in downtrends. We do see a little bit of a change, but nothing significant yet. You can pause this if you'd like. The comments from the previous charts apply. Nothing significantly changed. We'll head into next week with a flexible and open mind, and with a very specific if-then game plan in place. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currency, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog Short Takes, or watch past videos on the Shivako Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.